Ben Fulton, Elkhorn launched the S&P 500 Capital Expenditures ETF last week. So tell me why the world needs another ETF.
That's a great question. You know what we looked at, and after 20 years of being around ETFs, 10 years being at PowerShares, starting Elkhorn, what we were looking at was utilization of shareholder cash. How do companies use cash? It could be dividends, it could be buybacks. We've seen a great buyback rally for the last 3 to 4 years. But we think companies need to start employing and reinvesting back into their companies. And how do you measure that is really what we were striving for. We worked with S&P and they created a great index for us.
All right, and have they back tested that index? How has it done in the past?
Yeah, they actually have a little over a 20-year history on it. You can pull it up on the history of that. It's had about a 300 basis point outperformance over that 20-year time frame. So it shows a lot of great kind of silent success, and I think active fund managers have known this for a long time, but the ETF industry hasn't been able to participate.
Well, the ticker for your ETF is CAPX, makes sense. Talk about how it's comprised, what's in it?
Yeah, so what we look at is they're the S&P 500 stocks. We take 100 of the companies that, first of all, have to display a history of capital expenditures, but then most importantly, the history has to be an improving Capex to sales ratio. So not just do they believe they should reinvest, they have to be great at reinvesting and actually driving revenue. That magic formula means you have companies that you want to own.
We have heard a lot from activist investors who are pushing companies to give back cash, whether it be in dividends or buybacks. So are you saying that if they would actually push them to reinvest in the business, they would actually do better?
Well, I think for long term, it's a better approach. Buyback, I'll cynically say, a lot of times is compensation driven. It's to me a stock price for a short period of time. Long-term growth of a company means you need to invest back in and you need to change the way a business is operating and adjust to the times we're at. So I think you hate to say the activists are right, but the activists are probably right in this case.
We've also been hearing for a long time about all that U.S. corporate money that's parked overseas. They're too afraid to bring it back because of the tax hit. If and when it does come back, is CapEx the best place? Or because a lot of these companies are going to want to give it back to shareholders. I'm not saying it's a bad thing, it's just a different thing.
No, giving it back to shareholders, we all like that. And I think there's a lot of ways for an ETF investor to participate in that, whether it's dividends or buyback. But what we're looking is, I think there's going to be a lot of undue pressure and there's going to be a lot of companies looking at this because as they start looking, and I think it's the one way our economy is finally going to turn around is companies have to grow and add jobs. We can't depend on the government to do that for us.
All right, thanks a lot, Ben.
Thanks, Greg.
Thank you for watching The Street.